Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Recon Reports episode, we're doing a full tactical debrief on three recent covered call trades: Delta Airlines, Intel and Merck. Two trades used cash-secured puts as entry vehicles leading to assignment and covered calls, while Merck was a classic ex-dividend timing play like you've seen before. These three trades represent completely different battlefield conditions. One fighting sector rotation headwinds, one pure sideways theta collection, and one capital-intensive opportunity cost lesson. We're going to walk through each trade setup step by step, from initial thesis through execution, every management decision made, final P&L numbers, and most importantly, the raw lessons learned, including my execution mistakes, so you don't repeat them. Let's start with Delta Airlines, which was positioned as part of my broader energy sector rotation thesis. I was long multiple energy names like BP, Shell, Exxon, Petrobras, and XLE, while establishing a semi-short bias on airlines through Delta, since higher fuel costs squeezed their margins. The operational plan was clear: enter via cash-secured put, get assigned to establish the stock position, and then sell covered calls expecting the stock to either move lower or grind sideways. The primary risk was a sharp decline in Delta shares where option premiums wouldn't offset stock losses. Per my rules of engagement, I have a hard 10% drawdown exit rule on individual positions. Properly sized at 1 to 2% account risk, this protects the portfolio even if triggered. This rule was learned the hard way from my Nike disaster. I'll dedicate a full episode to that train wreck later. Back to the Delta trade. On March 3rd, I sold a March 6 strike 62 cash secured put and collected 49 in premium. The put was assigned at expiration, establishing my long position at $62 per share or $6,200 for 100 shares. From there, the first call I sold was the March 27 strike 62 covered call, collecting $174 in premium. Then, the price started moving against me and broke above my strike. I decided to roll the call up and out. On March 18th, I closed the original call for a 206 loss and sold a March 20 strike 65 call for 103 premium. On March 19th, I closed that call for a 77 profit and immediately sold a new March 20 strike 64 for 55 premium. On March 20th, I closed that call for a $40 profit. I then rolled up and out again, selling the March 27 strike 64 for 161 premium. The price action turned against me once more, so I closed that call on March 23rd for 149 loss. Because I wanted to capture upside on the move, I continued rolling the call up to strike 68. First for a 132 loss, then for a 131 profit. And finally, finished the trade with assignment at strike 65, collecting another 105 in premium. Now let's look at the numbers. On the stock leg, bought by put assignment for 6,200, closed by call assignment for 6,500, making 300 profit on the stock. On the options leg, most of my rolls were done at a net debit, meaning I paid more to close than I collected to open. Total options P&L came to a loss of $85. Combined, before commissions, this trade produced $215. That's a 3.6% return on capital, which hit my usual 3% target. From a profit and loss perspective, this trade was successful, but from an execution standpoint, it was far from optimal. The biggest mistake: strike selection. I was too narrow focused on the move in the stock price and didn't pay enough attention to volatility. I should have selected higher strikes, even if that meant lower premiums, to give myself more breathing room. Second, I violated a core rule from my own playbook. When you roll, you have to track your net debit credit religiously. In this case, I ignored that rule multiple times and paid for it. What ultimately saved the trade were the two last short calls, which finally turned the options leg from a net loss into a manageable wash. Key takeaway: covered calls are not a stay-alive panic tool. They're a precision income weapon. If you're rolling constantly at the net debit, you're not collecting theta. You're just bleeding money. Next up is Intel. This trade turned into a pure rinse and repeat operation, as I rolled calls from early February through early April. The thesis was straightforward. Intel looked like it was trading in a tight range around 45. I wagered it would stay in that zone long enough to facilitate several covered call cycles. Premiums were decent thanks to elevated volatility, and the stock wasn't expensive, so it wouldn't tie up too much capital. I entered the trade on February 12th, buying 100 shares at an average price of 47.60, a bit higher than I wanted, but still within acceptable range. Immediately, I sold a February 20th strike 48 call for 148 in premium. Over the life of the trade, I rolled the calls 9 times. I won't walk through each individual roll in detail, but you can see all of them on screen right now. Take a few seconds to scan the sequence. During that period, the stock moved sideways with occasional spikes up and down, but it always snapped back towards the 45 zone. Because I needed capital to deploy on a larger position, I decided to close the trade by taking assignment on April 2nd at strike 45. Now let's look at the numbers. On the stock leg, I closed the long position at 45. My average cost basis was 47.60, so the stock leg lost $260. Not ideal, but given that Intel had been trading closer to 43 in the prior sessions, choosing 45 as the exit wasn't a bad outcome. What matters is that I didn't exit on emotion, I ran the math first. On the options leg, across all 9 rolls, I collected $524 in premium before taxes and commissions. That offset the $260 stock loss, leaving me with a $264 net profit on the entire trade. In raw dollar terms, that's not flashy, but when you look at return on capital, I deployed $4,760 in capital, and the $264 net gain works out to 5.6% return on capital, well above my standard 3% target. In hindsight, I could have stayed in the trade longer and potentially booked even more profit on the stock leg as the price spiked higher in the following sessions. But that's true of almost every good trade. The market often runs exactly when you exit. The key lesson: if your method is consistent and your edge is positive, you don't need to catch every dollar. You just need to avoid a catastrophic loss. Over time, that's how you compound outperformance. Now let's move to Merck. If you watched previous Recon Reports, you know I often run covered call plays around ex-dividend dates. This one was a classic ex-dividend strike. The plan: buy the stock before the ex-dividend date, sell calls against the position to collect premium, exit the trade via assignment, ideally capturing the dividend as a bonus. I started the trade by selling a cash-secured put at strike 121, which was assigned on March 6th. After assignment, I established a full stock position and began selling covered calls. This position was large in terms of capital deployment, roughly 25 to 30% of my account. My hard rule is that I can only carry one outside position at any given time. Normally, single position sizing is 10% of the account or less, so this was a deliberate high conviction bet positioned around the dividend cycle. I held the position through the ex-dividend date, which resulted in capturing the dividend. It amounted to $0.85 per share or $85 total before taxes. As assignment didn't happen around the ex-div date, I kept selling calls against the position, collecting additional premium. I finally closed the trade on April 12th, selling the shares at an average price of $120.25. Now let's look at the numbers. On the stock leg, I closed the position for a 75 loss. On the income side, I captured the dividends for 85 and options premium collected over the life of the trade were 257. Combined, the trade produced 267 net profit, a 2.2% return on capital. Given the capital deployed and the holding period of almost a month, that result is subpar. The trade was marginally profitable, but it wasn't a good trade. The real cost here was opportunity cost. The capital could likely have been deployed elsewhere for a stronger return. We don't have a crystal ball, but we can read the battlefield in real time. If a trade isn't working in the first week or so, and it's not a long-term core holding, consider cutting loose and redeploying. My lesson: capital is not meant to be idle. If a position underperforms early and isn't aligned with your long-term thesis, treat it as a tactical asset that can be redeployed and put to a better use. To wrap this debrief, here's the mission recap in tactical terms. Delta was a sector rotation play with aggressive rolling. It hit my 3% return target but exposed a flaw in strike selection and roll discipline. Rolling for a net debit is not a long-term strategy. It's a short-term tactical error. Intel was a pure theta collection operation in a sideways range. Despite a 260 stock loss, disciplined rolling generated 524 in options premium, delivering 5.6% return on capital. This is what proper capital allocation and repeatable execution look like. Merck was an ex-dividend capital-intensive play that produced only 2.2% return while tying up almost 25 to 30% of the account. The dividend and premium were nice, but the opportunity cost was the real loser. When a big position underperforms early, it's often smarter to cut and redeploy than to hope it turns into a hero. Core takeaway: your methodology is your weapon. If your process is sound, your mistakes will be small and your edge will compound over time. And with that, we wrap up this episode of Recon Reports. We walk through 3 trades, how they were structured, how they were managed, and what each one taught me about execution, assignment, and risk control. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, stay on target.